Good morning. Here is today's Korean economic news briefing. Today's headlines are dominated by the escalating tensions in the Middle East and their profound impact on global and domestic economies. We are seeing a ripple effect from rising energy costs to a significant downturn in business sentiment, all while central banks grapple with the specter of inflation. Let's begin with a pressing issue for every household and business: gasoline prices. For the first time in 3.5 months, the price of regular gasoline has surged past the 2,000 won per liter mark across all regions in Korea. This sustained upward trend in oil prices is a direct consequence of the prolonged instability in the Middle East, specifically the US-Iran conflict. Global crude oil benchmarks continue to climb, inevitably pushing up domestic fuel costs. This situation directly affects consumer spending power and the operational costs for logistics and manufacturing industries, raising concerns about broader inflationary pressures. In response to these supply concerns, the Korean government has implemented a full export ban on domestically held or produced naphtha, effective today. This measure is intended to stabilize the supply for our domestic petrochemical industry, which has been grappling with raw material shortages. While the local industry acknowledges the government's intent, there are concerns about the policy's limited effectiveness in fully resolving the underlying supply issues. Crucially, this unilateral action is expected to spark significant backlash from major importing nations. Countries like China, which accounts for 44% of Korea's naphtha exports, and Japan, at 38%, along with various Southeast Asian nations heavily reliant on Korean naphtha, are likely to protest fiercely. There is a palpable risk that this could escalate into trade disputes, complicating Korea's international trade relations at a time when global supply chains are already fragile due to geopolitical tensions. The impact of the Middle East conflict is also starkly reflected in our domestic business sentiment. The Bank of Korea's Composite Business Survey Index, or CBSI, for March, came in at 94.1, indicating a significant deterioration in corporate sentiment. What is particularly alarming is the outlook for April, which has seen the largest drop since January of last year, immediately following the declaration of martial law. Despite strong performance in IT exports, particularly semiconductors, both manufacturing and non-manufacturing sectors are exhibiting deep pessimism. This suggests that the broader economic uncertainties stemming from the geopolitical conflict are outweighing the positive momentum from specific industries. The pressure on the everyday economy is also intensifying. Livestock farmers are facing a severe, double whammy. Rising oil prices directly increase the cost of fuel for farm operations and transportation. Concurrently, a weakening won makes imported feed, such as corn, significantly more expensive. Shipping costs for these commodities have also soared, in some cases doubling. This combination of factors is squeezing profit margins for farmers, and there are warnings that consumer prices for meat, particularly pork, could see substantial hikes, potentially reaching as high as 40,000 won for a single serving in restaurants. This highlights the direct and painful impact of global events on our dinner tables. Turning to macroeconomics, the ongoing conflict has solidified the fear of inflation globally. International oil prices, fueled by the US-Iran war, are indeed making inflation a stark reality. Even if the conflict were to conclude soon, its economic scars are anticipated to be deep and long-lasting. This predicament puts central banks worldwide in a difficult position. The dilemma is clear. Raising interest rates to combat inflation risks stifling economic growth, while not acting could allow inflation to spiral. The United States Federal Reserve, for instance, is increasingly expected to delay interest rate cuts until next year, with some even speculating about potential rate hikes if inflation persists. This signals a difficult period ahead for monetary policy, moving away from previous expectations of easing. Domestically, the National Assembly Budget Office recently revised up Korea's real GDP growth forecast for this year by 0.1 percentage points, citing a visible recovery in private consumption and facility investment, along with expanding exports driven by global semiconductor demand. However, this positive revision comes with a significant caveat. The office warns that a prolonged Middle East war could shave off up to 0.5 percentage points from our growth rate, potentially bringing it down to a challenging 1.5%. To mitigate these external shocks, the government's proposed 25 trillion won supplementary budget is being closely watched. Morgan Stanley forecasts that this budget, if fully executed, could boost Korea's GDP growth by approximately 0.15 percentage points, helping to counter the downward pressure from high oil prices, with a limited impact on inflation. In a contrasting development from Europe, France's fiscal deficit for last year came in at 5.1% of GDP, slightly better than both the previous year and government forecasts, although its public debt continued to increase. This offers a glimpse into how different economies are navigating their fiscal challenges amidst global uncertainties. On the financial markets front, the Kospi experienced a volatile trading day. It began with a sharp decline due to heightened inflation concerns from the US-Iran conflict and news surrounding Google's TurboQuant AI chip. However, the index staged a resilient rebound to close down a modest 0.4% at 5,438.87, largely driven by strong buying from individual and institutional investors, despite foreign investors offloading a significant $4 trillion in shares. The KOSDAQ, meanwhile, finished slightly higher. The Middle East crisis has also profoundly impacted bond markets. Expectations for U.S. interest rate cuts have plummeted, leading to a substantial decrease in the amount of U.S. Treasury bonds held in custody by foreign entities. The U.S. 10-year Treasury yield surged, temporarily surpassing 4.48%, marking its highest level in 8 months. This reflects increased investor risk aversion and a reassessment of future monetary policy. Concurrently, the Japanese yen has seen further depreciation, breaking past the 160 yen to the dollar mark, driven by prolonged war concerns and rising U.S. long-term interest rates. This weak yen further complicates Japan's economic outlook. Interestingly, amidst the volatility, the pharmaceutical and biotech sectors on KOSDAQ have shown relative strength, marking a potential shift in market leadership as previous growth engines like secondary batteries and semiconductors consolidate. One notable biotech stock has even seen a staggering 370% surge in just 3 months, surpassing the market capitalization of some established Kospi blue chips, demonstrating focused investor interest in this resilient sector. Moving to industry and technology, we observe a mixed but largely forward-looking landscape. OCI Holdings announced a major organizational restructuring and executive promotions, including the appointment of a new vice chairman and president, aimed at strengthening its core advanced materials and specialty chemical businesses. This strategic move is designed to enhance its capability to respond to the anticipated semiconductor supercycle and maximize efficiency and profitability in areas like battery materials and conductive carbon black. In another positive sign for the semiconductor sector, a new company founded by an Exynos father has secured 15 billion in funding even before mass production, indicating continued innovation in chip design, particularly for battery management units crucial for electric vehicles and robotics. Meanwhile, the electric vehicle battery sector continues its growth trajectory. Hyundai Motor Group and SK On have finalized the name of their North American battery production joint venture as HSBMA, Hyundai SK Battery Manufacturing America. This joint venture in Georgia, U.S., is now over 90% complete and slated for commercial operation this year, with an impressive annual capacity of 35 gigawatt-hours, enough for approximately 300,000 electric vehicles. This solidifies their commitment to the North American EV market and local supply chains. In the realm of artificial intelligence, Seoul City is pushing for an AI transformation acts across industries, moving beyond mere AI adoption to integrate AI as a core driver of productivity and innovation. Businesses are increasingly leveraging AI employees for everything from recruitment to report generation, significantly reducing costs and boosting efficiency. However, the AI landscape is not without its shifts. OpenAI, in anticipation of a potential IPO, is strategically pruning its operations, reportedly postponing the launch of an adult mode, and withdrawing from certain video generation platforms to focus on more immediately profitable ventures, reflecting a dynamic and competitive market. While some concerns have been raised about AI's potential to reduce memory usage and thus semiconductor demand, analysts remain optimistic that the overall expansion of AI applications will ultimately drive greater demand. On the real estate front, the rental market is facing an acute crisis. A severe shortage of both Jaeon's and Wolse properties in Seoul and increasingly in surrounding Gyeonggi areas like Gwangmyeong and Dongtan is driving up prices significantly. This scarcity is pushing some residents to consider purchasing homes, particularly mid to low-priced apartments below 1.5 billion in areas like Naeon, Dabong, and Gangbuk, which are seeing price increases even as the upscale Gangnam market shows signs of slowing. This trend is partly fueled by relaxed loan regulations for first-time buyers in these segments and multi-homeowners offloading properties to avoid capital gains taxes. For those involved in urban redevelopment projects, the concept of Kwanli Jae, or appraisal value, remains key in determining eligibility for new apartment allocations. Internationally, the Middle East conflict continues to deepen. Despite U.S. efforts to delay broader strikes and pursue negotiations, Israel has independently bombed Iranian naval missile and mine production facilities, asserting its resolve to see it to the end. The U.S., meanwhile, maintains that negotiations are progressing smoothly. Compounding energy security concerns, Iran has reportedly contemplated levying tolls on the Strait of Hormuz, a critical choke point for global oil shipments. Such a move would have severe repercussions for energy-dependent economies like Korea, significantly escalating import costs and further disrupting global trade. Looking ahead, the global geopolitical landscape, particularly the Middle East conflict, remains the most significant variable influencing our economic trajectory. For investors*, this calls for heightened caution and strategic diversification. While the overall market faces headwinds from inflation and delayed interest rate cuts, specific sectors like resilient biotech, advanced semiconductor materials, and the electric vehicle battery supply chain show growth potential. Monitoring currency fluctuations and bond market movements will be crucial. For the general public*, be prepared for continued upward pressure on daily living expenses, especially gasoline and food prices. Prudent financial planning and managing household budgets will be essential in navigating these challenging economic conditions. That concludes today's economic news briefing. Thank you for joining us.